You place a stop loss to protect yourself. You follow the rules. You manage your risk. And then price drops exactly to your level, takes you out, and immediately reverses. That wasn't bad luck. That was by design. Market makers don't trade against the market. They trade against retail traders. And there are 5 mechanics they use to do it every single session. The liquidity pool beneath every stop in institutional trading. Stops aren't protection. They're fuel. Every cluster of retail stop losses sitting below a support level represents a pool of available liquidity. Sell orders waiting to be triggered. Market makers need that liquidity to fill their own large positions. Psychologists call this an asymmetric information advantage. You thought you were managing risk. They saw inventory. Market makers don't move price randomly. They engineer short, sharp spikes, called stop hunts, designed to reach just below the obvious level where retail stops cluster. The spike triggers the stops, collects the liquidity, then reverses. The candle leaves a long wick on the chart. That wick is a receipt. It shows exactly where the liquidity was taken. One of the most consistent manipulation patterns is the false breakout. Price pushes through a key level, a level every retail trader is watching, triggers by orders and stop losses simultaneously, then reverses hard. Behavioral finance research shows retail traders are conditioned to enter on breakouts because breakouts feel like confirmation. Market makers know this. They engineer the confirmation. Before major economic events, Federal Reserve announcements, jobs reports, CPI data, institutional desks run deliberate, pre-event sweeps of obvious retail stop clusters. They clear the liquidity before the real move begins. Retail traders holding positions into the news often get stopped out before the move they correctly predicted. They were right about the direction, wrong about the timing. That gap was manufactured. Here is the part nobody says directly. The most popular technical analysis levels, round numbers, prior highs and lows, trend lines, 50 and 200-day moving averages are popular precisely because millions of retail traders use them. And where millions of retail traders place stops is exactly where market makers look first. Your chart isn't a secret. It's a shared document. Understanding market maker manipulation doesn't mean the market is unbeatable. It means the game has rules you weren't taught. Professional traders don't place stops at obvious levels. They place them where retail logic says not to. The moment you stop trading like a retail trader, market makers lose their map, and you stop being the liquidity. If you want to understand how institutional money really moves and how to stop being the target, follow for more. Because the market doesn't move randomly. It moves with purpose.